If you're looking to buy a home, I would highly suggest that you wait. The markets are not looking good. If you are in real estate, if you're looking to invest and buy properties, just a week ago, it made it a little harder for investors to start buying now because they want to give home buyers an opportunity to start buying properties. Now, guys, I would suggest that you guys wait. We're going to be going over charts. I have not seen anyone all over YouTube going over charts, okay? Going over charts of mortgage rates and seeing the historical data between the mortgage rates and the 30-year treasury. They are literally identical. If you guys look over here on the 30-year treasury, look at this pattern right here that I'm circling on, and then look at this pattern right here on the mortgage rates. It's literally the same exact thing. Now, what we're going to be going over is we're going to be predicting the interest rates. In this video, we are going to predict interest rates. We are going to predict we are basically predicting what the Fed will eventually get the interest rates up to or down to. So we're going to give two scenarios of where we're going. So right over here on the mortgage rates, look at this. So on October 27th to November 10th, 2022, we had a double top. With this double top formation, what we had is we had a double top. We had bearish divergence on the RSI. So we're having a lower low over here, showing that we're losing momentum. Look at this. Even the MACD. Look at this. Look at the 30-year treasury. We had a double top, but we had a lower low, right? We had bearish divergence. We had bearish MACD divergence, and we had bearish momentum divergence. I mean, guys, it doesn't get easier than this, okay? So I mean, guys, I have been holding this information that I'm going to be going over today for around a month and a half. I just didn't have time, but I really wanted to bring this video out to help people if you guys are looking to buy homes. So now, since we went over that and we went kind of over the basics, what we're going to do is we're going to go over here on the weekly time frame, and we're going to be looking at the 30-year the 30-year mortgage rates, right? The interest rates. So right now the interest rates are at 6.79%, right? It's right here over here. Now over here, what we had is, so we have a specific pattern that I usually see, and this type of pattern, it's not a good pattern for the interest rates. Typically, how this pattern works is, I mean, I'll have to go on a higher time frame for you guys to understand. You typically have one rally up, then you have you kind of have a bounce back, followed by another rally with a bounce back, and then you go up for the third rally. Okay, once you go up for the third rally, it should be the same height as this one, as the first rally or the second rally, but for the third time. Once we hit the third rally, that's when we'll then form a double top. And once we form that double top, that's when we fall back down. But typically when we fall back down, we fall down and use this level as support. So worst case scenario, guys, we are going up to at least, I would say minimum 14% interest rates. I mean, it is possible we can break that and we can beat the highest interest rates, which was back in the 1980s. It was 18.63%. I honestly think we can break that if this pattern forms. But I mean, I'm just giving you guys a heads up, guys. So that's the whole thing. Now, what we see here forming is we see a double top forming. Now, I mean, I wouldn't say I'm really sticking to this pattern right here by having the third rally. And typically how you can do that is you can just kind of measure it from the first rally. So you measure the first rally just like how I did. You would move it and that'll give you a prediction of where it will go. Now over here, we cannot really see the numbers, so we can't get an accurate prediction, but that is a way that we can do it. Another way is we have a double top forming, right? Let's say we had this double top, okay? Let's give a nice scenario, okay? Let's say we come up here. We are having bearish divergence. So as we're going up here, the MACD looks like it's going to cross, but it's not. It's actually going for a little curve, right? You see that little tiny curve on the MACD? Okay, so we are about to, it looks like we're losing momentum on the MACD over here on this momentum. It looks like we're going to flip down to the downside. The smaller these little bars get, the closer we are to switching. And when we switch, we go down. And when we're up, we go up. So it looks like we're losing momentum, which we are, and it's kind of giving false readings, showing the MACD is about to go up. This chart is getting messy, so I'm going to go back. I'm going to draw it over again. And basically what that means is, best case scenario, if we hit this top right here and we use this level as resistance and we have bearish divergence still, the MACD will then, we would want to see a little sign over here showing that it's about to cross, which we will most likely see it cross. It will just kind of do a quick curve. The momentum will then drop down. Where would we be heading? We would be heading here. So I'm going to actually do this measurement over here. How you measure where you're going to drop to is you measure from the top to the bottom of these candles and you move it over here, and it'll give us a 5.25 interest rate. Okay, it's also going to be using this level as support. Okay, now it's not that perfect, guys. It really isn't that perfect where it just drops exactly to this measurement. It can drop, you know, down here. It can use this level as support, right? But if it were to break that, at minimum, with this measurement, and this measurement is a measurement of 13.65. Okay, 13.65. Let's remember that we're gonna use that measurement later. If we were to break this and we were to go up, well then we would be at this mystery level over here, and I would call that maybe around I would say 14. I would say anywhere between 11 to 14%. But you guys have to keep in mind, remember this pattern over here? You usually have a pattern with a rally followed by a pullback, followed by another rally, followed by a pullback, and then you go for the third rally. Then you form the double top. So that's just a heads up. If we look over here and we go over here on the weekly, look at this, okay? We're going to go over here to 30-year Treasury, and I want to show you guys how you can see what's going to happen. Look at this date right here, okay? 20th of April, 3rd of August, 2020. What we had here, now it's easy for me just to show this because it's already showing what happened, but I'm going to show you guys how it's easy to predict this even if we don't have this part over here showing. This part where I highlighted inside the box, if we didn't have that showing and we were live back on this day, how we would predict that the markets are going to go up is you had bullish divergence. Look at this. Do you see that? You have bullish divergence as price is staying down here. You have a candle over here showing that, you know, sellers are losing momentum, buyers are coming in. Now, that's typically how we read stocks, right? When we read stocks, when we read the S&P 500 and the NASDAQ, that's typically how we read them. You know, look at this. You had this candle over here. One second. I don't know why my chart is acting like this. It's not inspecting it. One second, guys. Yeah. You see this right here? Okay. You can either call this a hammer. You know, you can call this a hammer. Basically what you have here is you have, you know, it's on a moving average. It's showing you that sellers are losing momentum and buyers come in for a little bit, right? Over here, same thing. I mean, it's typically how, it's really how we read stocks and how we read charts in general. But I mean, you can predict these things, and look at the MACD. I mean, the MACD, everything, even here you had bullish divergence. So it's very easy to predict these things. Look at this, bearish divergence at a moving average. Okay, where did we drop? We dropped a lot below. I mean, look at this. If you did the measurement from here to here, it wouldn't even give you this this low of a prediction. So the markets kind of move on its own. Over here, what we have going on is on this chart over here. Do you guys see this right here? This is a level of strong support. Strong resistance. 7.12 interest rate. Look at this level, 7.12. Okay, what are we doing here? It's literally the same exact pattern. That's forming on the 30-year Treasury. They're literally entwined. They're literally together. And over here we have bearish divergence. I mean, this is very strong bearish divergence. And when it goes up to this top right here, you're going to have even stronger bearish divergence. So we are going to have a drop. I believe we are going to have a drop, but at the same time, it's kind of, there is that chance that if we were to break this level, like we went over on the monthly, we can, go up to 14%. And if we were to go up there and it were to kind of, consolidate up there, I would see us breaking the all-time high, which would be 18.63% in 1981. Of course, this does not happen overnight. This will take, I would say, up to a year if it were to go up to 18% by next year. But yeah, I wanted to bring this video. I have not made a video in a while, so it's kind of hard for me to put into words what I'm trying to say. I usually just kind of have all my thoughts in my head as I read stuff. But yeah, I hope you guys kind of understood this video. I hope you guys stuck around and you guys learned something. But this is such valuable data that others are not sharing. Others don't even know how to read. You have a lot of real estate agents. You have a lot of investors. You have a lot of people putting a lot of money, in buying properties, and you have to know how to read the charts. You have to know how to predict these things. If you can read a chart, reading a chart is like reading a language. You see here, this is the VIX, this is the volatility. You got the dollar. I mean, yeah, when the dollar goes up, markets go down. And when the dollar goes down, markets go up. I mean, guys, look at this. Anyways, so I came back from New York, Wall Street, around a month, 2 months ago. The higher ups over there, I didn't really have a chance to show them, my YouTube videos or my chart reading skills. If you guys find value in this video, if you guys are chart readers, if you guys have friends in Wall Street or anything like that, put a good word in for me, guys. Come on, help your boy out. I'm getting ahead of myself. If you guys enjoyed this video, please leave a like, please subscribe, please share with your families. And I'm probably not going to make a video after this because I really want to make this video just to get it out because I've been holding this off for a whole month. But yeah, guys, if you guys enjoy this, take care, leave a like, and yeah. All right, you know what? Bye.